sir is the indirect taxes practice vertical at Guru and Jana Chartered Accountants. He's also co-authored the book GST, Where Did My Profits Go? He handles representation services before CESTAT and quasi-judicial authorities, and a lot more like that. So we are very privileged to have such an expert with us for the day. And let us just carry on with the meeting.
Thank you, John. John, are you able to see the screen?
Not yet. Yes, sir. Yes.
And is it moving?
Yes, sir. Yes, sir.
Okay. Okay. Thank you, John.
Yes, sir.
Good evening to all. Yesterday, we deliberated on GSTR 9 annual return. Today, we will discuss on GSTR 9C, a reconciliation statement. Previously, it was an audit which has to be carried out by the chartered accountant or a cost accountant. But however, taking into consideration the industry requirement, the finance ministry has taken out the audit part and made it as a self-certification. Before we dwell upon GSTR 9, I just want to recapitulate what we have discussed yesterday, because it will have a relevance with regard to GSTR 9C, what we are looking today. Predominantly in GSTR 9, we tried to reconcile the turnover basically from the outward, inward, and the transactions which are pertaining to the current year, but however disclosed in the GSTR return 3B and 1 in the subsequent period up to the specified period. When I mention the specified period, it is up to 30th of November of subsequent period. Now the outward supply is bifurcated into two categories. One, the disclosure of transaction on which tax is payable. It has got various category of transaction such as B2C, B2B, exports, SEZ supply, deemed supply, advances. Also, it has got the transactions such as deemed supply. So we need to take into consideration why this categorization in the first instance, when the tax is being paid on the transactions, why this classification is required to be disclosed in GSTR 9. Point number one, each line item has got its own relevance. Now, if you take into consideration B2C transaction, up to 5 crores, there is no requirement to disclose the HSN code. However, for B2B, it is required. So therefore, each line item has got its own relevance. So accordingly, it is been classified in the GSTR 9C as well as GSTR 1. However, in GSTR 3B, we give the information in a consolidated manner, unlike GSTR 1. Now, I further dwell upon a couple of instances, particularly with regard to SEZ supply and exports. Now, there are conditions attached to SEZ supply as well as export supply. In case if it is a supply to SEZ, within 3 months, we need to obtain the endorsed copy of the invoice from the specified officer of the SEZ, stating that the goods or services are being used for specified purposes. Now, what will happen in case if we don't get the endorsed copy? In those cases, even though we are utilizing or making use of LUT against the supply to SEZ, this transaction will be subjected to tax. So it is a conditional zero-rated supply. Just to give a couple of instances, there is a allied educational institution which was providing services to SEZ unit. since from 2017-18. However, the educational institutions were not obtaining the endorsed copy of the invoices from the SEZ recipient. The books of accounts were subjected to audit under Section 65. Notices have been issued, and when we submitted the information, the departmental authorities found that there is a SEZ supply, and they called for endorsed copy of the invoices. Assessee stated that these being the initial stages and there is no specific requirement to obtain the endorsement, they did not provide the endorsement, and ultimately an order has been passed demanding tax on the SEZ transaction. See, why I am referring these kind of instances at this stage, at the beginning of the reconciliation statement here, is that we need to understand the implication of each and every line item, what is being stated in GSTR 9, because it will have a bearing on the tax liability. Now coming to exports, as you are witnessed that during COVID times, many of the entities who were doing foreign supply, either it may be goods or services, they were not able to collect the amount on account of supply. So there was an outstanding. These outstandings were beyond 1 year. Now, under these circumstances, in case if the amount is not received within 1 year from the date of the invoice, then within 15 days, the assessee has to seek a permission from the commissioner of the jurisdictional authority, seeking extension of time. In case if they don't do it, what would be the repercussions? Point number one, the LUT will not be valid for all the supply which they undertake without permissions. For that, there is an exposure of output liability at the rate of 18%, which will be a very huge as far as exports are concerned or entity is concerned. It will hit their bottom line. Sometimes the TP profit margin is to the tune of 15%, but whereas our GST liability is 18%, so therefore there are chances that the entity will incur the loss. Now, coming to the other aspects, that is with regard to transactions where there is no tax liability. They wanted to capture these informations, though it has got no relevance from the reconciliation point of view. But however, I would like to stress upon certain things. When we look upon GSTR exempted turnover or nil turnover or a non-GST supply, these categorization has to be proved beyond doubt. When there is an exempted supply, we have to ensure that the condition attached to those exemptions has to be fulfilled. Just to give one example, in case of an training institution, they were exempted under 12/2017. But however, the conditions for exemptions have not been fulfilled. But however, the entities were claiming exemptions on a year-on-year basis. When the entity was subjected to GST audit, and when documentary evidences were called upon, they were unable to provide the documentary evidence. So at that point in time, the department has confirmed the liability, and these liabilities were confirmed for 3 consecutive years. So there is an exposure of tax, interest, as well as penalty. Sometimes this will be to the tune of 50 to 60% of the total turnover. So kindly ensure that when we are making a disclosure under the category where the turnover is not subjected to any tax, we have to be very careful. And all the conditions attached to those things are being fulfilled. Documentary evidences such as endorsed copy of the invoices in case of SEZ supply, or EBRCs in case of foreign exports, have to be there on record. Otherwise, there would be an exposure. Now, coming to the third aspect, that is based on this, we would have declared the taxes in the GSTR 3B. The first one was the supply on which tax is payable. The second table discloses the turnover on which there is no tax liability. However, the RCM has to be removed, which is not a part of the turnover. It is separately paid and ITC will be claimed according to that. Further, as you are aware that under GST, there is no mechanism to file the revised return. The only option available is to correct or to make the amendment in the subsequent period in which the errors or omissions have been found out. So under those circumstances, obviously, the transactions would be reported at a subsequent period or after the end of the financial year. So in those cases, those turnovers has to be, has been disclosed in the subsequent period, which also calls for a reconciliation. So there is a separate columns, both for outward as well as inward supplies, which will be disclosed in GSTR 9. So these are all spillover transactions. So an entity need to have a reconciliations kept, otherwise it will be a problem at a later point in time. The last category is with regard to the other informations, wherein we provide the informations with regard to refund, demands raised, so on and so forth. Another important aspect is with regard to HSNY summary. Outward, it is compulsory. As far as inward is concerned, it is optional. So with this, we will be able to file GSTR 9. Now, before we dwell upon GSTR 9C, I would like to stress upon certain basic things. Point number one, we need to have the working in one working file. Many a times it may so happen that the informations are scattered. Now this will become or pose difficulty in preparing GSTR 9C, and also sometimes at the time of representation before the departmental authorities, we find challenges because the informations are not handy. Kindly ensure that there is only one working file with regard to GSTR 9C. That is point number one. Point number two, there are many reconciliation statements which has to be kept before we take up GSTR 9C. Point number one, outward reconciliation between GSTR 1, 3B versus books. Point number two, ITC as per books, 3B as well as 2A. This has to be kept. The third important aspect is with regard to RCM. So it should be basis the imports, the taxes paid on imports, both as goods as well as services, as well as domestic RCM liability. This has to be matched with ITC, what has been claimed on a monthly basis. Further, we have to take into consideration the timing when this RCM has been disclosed. Now, whether the RCM is pertaining to the previous period disclosed in the subsequent period, then kindly ensure that that RCM should not form part of GSTR 9 of the previous year. It should be disclosed in the year in which RCM has been paid. So these are the basic aspects which we have to take into consideration before we start with GSTR 9C. Now we have seen what needs to be kept in mind as far as GSTR 9 is concerned. Now we move on with GSTR 9C. Point number one, where the aggregate turnover of an entity exceeds more than 5 crore. This is PAN level. Take an example that an entity has got 5 registration at 5 different states. The turnover of all the 5 states put together based on the PAN is more than 5 crore. Then in that case, the GSTR 9C is applicable. Now take a scenario that out of 5 states, only one state has got a turnover and all the 4 states has got no turnover. They are filing nil returns. Even though they file nil returns, they have to file GSTR 9C compulsorily. So it is on an entity level turnover has to be considered. And once it crosses more than 5 crores, GSTR 9C has to be filed. Now the question arises, what needs to be filed along with GSTR 9C? So we need to file the annual return, the copy of audited annual accounts, and a reconciliation statement in 9C has to be filed. The due date for filing 9C is 31st of December. We are left with almost only 1 month, and there is no possibility of extension. We have been used to extension of GSTR 99C in the earlier period, but mind you that from the previous year, there is no extension. We don't see any extension this year as well. It is always better to file both GSTR 9 and 9C together. The reason being is that when you are comparing 9 with 9C, there are chances that any liability which has been missed out can be taken into consideration in 9 itself, and then the payment can be made in DRC 03. Otherwise, there will be a reconciliation between 9 and 9C. To the extent possible, avoid the reconciliation between 9 and 9C where there is a difference in turnover or ITC. Kindly adjust everything in 9 and ensure that the differences are 0 to the extent possible, so that you will not receive any kind of notices from the department. Just to give you an example, in one of the cases, an assessee has declared an extra 0 in the GSTR 9C, because of which there is a huge turnover gap. And immediately the department has issued a notices, and then we have to reconcile with GSTR 9, provide the explanation that there was an inadvertent error in capturing an additional 0, and it has to be substantiated to the authorities, and based on that, they drop the notice. Further, based on this observation, CAG auditor also has issued notices for the same period with the same observations. So we have to once again give the explanation. So sometimes it will create a nuisance in case if there are any differences, either arithmetical or whatsoever. So kindly ensure that it is being verified. There should be a maker and checker checks so that all these errors are ironed out before filing the GSTR 9C. The most important aspect that we need to take into consideration is invoice level reconciliations. Either it may be outward or it may be inward or RCM. We need to have invoice level reconciliations, then only we will be able to identify the differences. If you are doing it on an overall basis, you will not be able to identify where the error is. So kindly ensure the working paper should have the invoice level reconciliation. As I mentioned earlier, kindly file the nil return in case if there are multiple registrations and if any of the registration is not having any turnover. Then in that case, please do not ignore. You file the nil returns in order to avoid the late filing fee. Kindly ensure that there is a verification mechanism so that there is no error which is crept in GSTR 9C or 9. and these returns cannot be revised. Now, what are the changes in GSTR 9C? There are only a couple of changes. One is there is a new rate which is being prescribed, which is applicable only in case of brick manufacturing. And another thing is with regard to table number 14. So this is the table which captures expense-wise details, ITC claimed based on expense-wise. So this has been continued as an optional field. However, it is always better. The reason being that when a particular entity is called for an audit, the officer would like to see what are the expenses on which ITC has been claimed. The reason why they want to see the categorization of ITC based on the expenses is that they want to understand, are there any blocked credit? For example, staff welfare expenditure or car hire for an employee. Either it may be a works contract services which has been taken for the purpose of construction of an office or a factory, or it may be the purchase of goods or services with regard to construction of office or a factory, barring certain exception. So under these circumstances, the officer would ask the assessee to prepare the ITC based on the expense wise on which ITC has been claimed, on which ITC has been blocked. Further, when you are preparing the input tax credit register, ensure to capture the HSN or SAC code. This will be handy when you prepare the when you present before the authorities, because they would be asking for invoice copies. Otherwise, it will add on to your extra effort in pulling the informations with regard to invoices. In case if SAC code or HSN code is provided, based on that, the authorities will be able to take whether it is allowable expenditures or block credit or restricted. The most important thing that we need to take into consideration here is that as far as GSTR 9 is concerned, still we are referring to GSTR 2A. However, when we are filing the GSTR 3B return, we are comparing with GSTR 2B. So there are possibilities that there would be a wide difference between these two statements. In those cases, it is always better you may raise a grievances on the GST portal and bring it to the notice of the authorities, so that in future there will not be any unforeseen events. Now, what are the documents required before we start with GSTR 9C? First thing is audited financial statement. This also is required as far as GSTR 9 is concerned. Ensure that registration-wise trial balance is there. And if possible, kindly get the authorization from the management, or if the statutory auditor is certifying, it is really good, because that will be taken at the face value. We need GSTR 9 filed return or the finalized GSTR 9 along with the supporting documents such as GSTR 3B, GSTR 1 returns, as well as the system computed summary report GSTR 1 and GSTR 3B as well as 9. Also obtain IT returns so that the turnover details are reconciled with the turnovers as per the GST return. This is an area where most of the people, they don't give importance. But however, when the audit is completed or when self-certification is completed, there are chances that there are huge differences between IT returns and GST return. This may be because of the accounting policies. I would like to stress upon the areas where such kind of differences would exist. Number one is the turnover as far as financial statement is concerned is based on the matching concept. But however, under the GST, it is based on the time of supply. So there are possibility that in case if we receive the advances, these advances may not be a revenue as far as financial statement is concerned, it is a liability. But however, from the GST perspective, the assessee would have discharged GST liability as soon as he has received the advances. So this is only with regard to services and not with regard to goods. Further, there are chances that the assessee may be into both taxable supply as well as exempted supply, and they may be having a cross-charge mechanism. So what is cross-charge? Take a scenario that an assessee is having two registration in two different states. Under these circumstances, they do not have the accounting team, the HR team, or the IT team. All these things will be managed from the HO. The branch will not have the independent resources as far as this is concerned. So under these circumstances, in case if the branch is able to take the full input tax credit, then in that case, whatever the value attributed by the HO to the branch can be taken as an input by the branch, and there will not be any question on the valuation. But in case if there is a both taxable as well as exempted turnover, then in that case, valuation will kick in. The reason being is that they will not be able to utilize the input tax credit. It will not be a scenario of a revenue neutral. So under these circumstances, the valuation has to be adopted. So in case if it is a related party, if further supply is being done, then in that cases, they need to value the transactions, and accordingly, it has to be reported for the GST purposes. However, under the income tax or for the purpose of financial statement, this will not be a turnover. So there is always the possibility that there might be a turnover in the GST return, but however, the same is not recognized in the financial statement, or there may be a vice versa. Now moving on to the 26A statement, what is the relevance of 26A statement? Here we need to take into consideration the turnover what has been disclosed in GSTR in the IT return as well as GSTR returns has to be mapped with 26A statement. The department, when they call for an audit, invariably ask for a reconciliation because all these three items will have a differences. So this has to be reconciled. Now, in case if it is reconciled well in advance, it becomes easier to give appropriate disclosures in the respective returns. Now, we need to take into consideration electronic credit ledger, electronic cash ledger, and also the DRC03. So there are situations wherein assessee would have discharged the tax liability through DRC03 when there is a notices and the department specifically asked to discharge the tax liability. The assessee would have taken the route of GSTR 03 and discharge the tax liability. We need to have these informations in hand. Now we move on to GSTR 9C. So basically what we are doing in GSTR 9C is that we are capturing the basic detail, which is similar to GSTR 9. The only additional point that is captured in GSTR 9C is, are you liable to audit under any other act? Here we need to give the provisions under which we are subjected to audit. Then there is a reconciliation of turnover declared in audited financial statement with turnover declared in GSTR 9. So this is very relevant. So for the purpose of GSTR 9C, the turnover as is disclosed in GSTR 9 has to be compared with financial statement. And once we know the supply, then we have to reconcile the taxes paid. And we move on to the reconciliation of ITC credit. If there is any additional liability due to non-reconciliation, that has to be discharged. So basically what we are doing is we are comparing the outward supply. So outward supply has got, as far as 9 is concerned, is a composition of both taxable as well as non-taxable turnover. And we arrive at a taxable turnover as far as 9C is concerned. Reconcile with the taxes paid. We do the reconciliation of ITC. And then if any additional tax liability is there due to non-reconciliation, the taxes will be paid. Now, with regard to the basic information, it is similar to GSTR 9, as I already mentioned. The only additional field which captures is the name of the act, if you are liable to audit under any act. So normally you have come across audit under income tax, that is tax audit, or it may be a company audit in case of private limited company. So this fact has to be disclosed in serial number 4. Now moving on to the table number 5, that is reconciliation of gross turnover. Now turnover including export, this is as per the audited financial statement for the state or union territory. This one need to take into consideration. Now we take the same example, that is an entity is having a 5 registration in 5 different states, and they have got only turnover in the state of Karnataka, which is also a head office. Under these circumstances, the turnover pertaining to only Karnataka state, when we are doing a GSTR 9, has to be taken into consideration. So for these purposes, you need to have a trial balance. And in case if this trial balance is certified by the statutory auditor, it is well and good. Otherwise, we have to get the management authorizations on this trial balance. And the same thing can be uploaded along with 9C. Though it is not a requirement, but it is always better to make it a part of your 9C. Because at least the department cannot take a position that information has been suppressed. Since it is already uploaded in the portal, which is available for review of the departmental authority, we can state that the information is already provided. Taking the turnover as per the audited financial statement as a base, we arrive at the turnover as disclosed in GSTR 9. Now table 5B to 5O invariably have the line items which has differences between GSTR 9 and audited financial statement. Now we will see each line item one by one. And also their treatment, whether it has to be added or deducted based on each transaction, it has to be evaluated. Having done this exercise, in case if 5R column is 0, it is a safe, but however, normal circumstances, always you will find a difference for one or the other reasons. If it matches, then we have to be doubly sure that there are no errors, omissions in our reconciliation statement of gross turnover. Now we will take into consideration each line item one by one. Point number 1, as I said, GSTN wise turnover has to be declared here. For example, if there is 50 crores on an overall basis and only 20 crore is pertaining to Karnataka, then only 20 crore has to be taken into consideration. So for that, how do you come to know about the turnover? For that, you need to have a trial balance of respective GSTN. Now, we also need to consider indirect incomes, forex fluctuation, profit sale of asset of that respective state or GSTN. This needs to be mapped with the trial balance as well as GSTR 9. Wherever there is a single registration, the turnover of the state must reconcile with the turnover disclosed in the audited financial statement, or the reasons whatsoever has to be there. In case if the differences leads to any additional liability, that has to be discharged. Now we have to be very careful where there are multiple registration. Now the turnover in a state must reconcile to the turnover as recorded in the books of accounts of each registration. Now when you are carrying out the GSTR 9C, kindly ensure the books of account for the respective registrations have been maintained at that location, point number 1. Further, all the documentary evidences such as with regard to invoices, input, output, receipt voucher, payment voucher, self-invoicing, refund vouchers, all the documentary evidences such as LUT, registration certificate is being kept at that particular locations. Because in case if the departmental authorities comes for an audit, they call for the books of accounts and it has to be maintained at each of the additional place of businesses along with the principal place of business. Also ensure that the addresses captured in the registration certificate is up to date. Most of the times it may so happen that there is a change in the premises, however, it is not been reported in the GST registration by way of an amendment. So what would be the repercussions in case if it is not reported? Though it seems very silly, but mind you, whatever the invoices have been issued to the new location, which is not been added in the GST registration, the ITC on those invoices, which is not a part of GST registration certificate, will be denied. So kindly ensure the date when the amendment has been happened, and also check for the invoices post and pre amendment so that appropriate actions can be taken. Now, as we are aware that e-invoicing is applicable for most of the entities, and in case if the change in address is not intimated to the vendors, and if the vendor captures wrong address of the customer, then the ITC will be denied based on verification of the address as captured on the e-invoice when compared to GST registration of the recipient. So kindly ensure these are all small things but make a lot of difference. ITC is nothing but the cash. So any ITC which is being denied is a cash loss to the entity. Ensure optimization of ITC when you carry out the GST audit. Other important aspect in case of multiple registration is that kindly have reconciliation of turnover for the respective states, and also a final reconciliation which will match to your audited financial statement, so that any differences can be adjusted appropriately in the respective states. Otherwise, there will be a difference which will be reflected in the reconciliation statement, which will lead to demands. Now we move on to each line item, that is unbilled revenue. So what is this unbilled revenue? This unbilled revenue is a revenue recognized in the books before the issue of an invoice at the end of a particular period. So it is been there as a part of the accounting concept, that is matching concept. However, this unbilled revenue at the beginning of the financial year, in order to get these informations, we have to refer to the previous year audited financial statement or the financial statement of the previous year, which has been captured on a comparative statement. From there, we have to take this information. Now, unbilled revenue at the beginning of the year can be merged and disclosed in the table 5O, which is an optional thing. But however, it is always advisable not to exercise these options. Since it is only a one-line items, it is better to disclose in the respective tables so that reconciliations becomes meaningful. The other aspect is value of all advances for which GST has been paid, but the same has not been recognized as revenue. The moment when we receive an advances without supply of goods or services, as far as financial statement is concerned, revenue will not be treated as earned, and it is recorded as a liability in the balance sheet at the end of the financial year. But however, from the GST perspective, the amount of tax would have been discharged on that and is a part of turnover. Where every registered person is required to maintain a separate account of advances received, paid, and adjustment made thereto. See, I'm also referring to the books of accounts to be maintained wherever this relevant is there. I'm trying to stress upon that so that this becomes a part of your reconciliation statement and also the workings. So you need to have a working, whatever the amount has been received, out of that, how much of amount has been paid back without rendering the goods or services. Normally it is by way of a refund voucher, and the adjustment where invoices has been raised. So those detail has to be kept handy. Now, advances where GST is not payable need not be identified, need to be identified, such as advances for goods or advances for exempted services, and only advances on which GST is liable should be considered for adjustment. Now, advance which are in the nature of financial transactions, sometimes there would be a loans. So these things are ignored because on these transactions, GST has not been paid. So therefore, there will not be any difference between financials and GST return. Now, report transactions which are not reported in the financial statement. So these are nothing but the branch transfers. So though the same are reported in the returns filed, now We'll continue with the same example. We have got a branch and HO at Karnataka, branch at Tamil Nadu. Now, in case if HO supplies goods to the branch for further sale, in those cases, as far as Karnataka is concerned, there would be an outward supply. Under VAT regime, it would have treated as a branch transfer, and there is no levy of tax in case if relevant forms are provided. The same is not continued under the GST regime. It will be treated as a supply, similar to a third-party transaction. But however, when consolidation of financial statement will happen, this will be knocked out. So therefore, identifying these transactions will become much more challenging. So for that purposes, one has to refer to the delivery challans maintained by the entity, stock inward, stock outward. Further, they have to refer to e-way bills. Most of the time, it may so happen that the reconciliation between e-way bill and purchase and sales are not being done. When you take out the e-way bill register from the portal or transaction from the portal, that will throw a lot of information so that appropriate queries can be posed to the assessee, and then the informations can be called for. So under these circumstances where there are branch transfer, kindly ensure that reconciliation between e-way bill, delivery challan is being made and appropriately disclosed in the respective returns. The branch will be able to claim the input tax credit provided the goods are taxable. In case of exempted goods, then ITC would be restricted. So kindly ensure that the HO has charged the taxes and branch has claimed the input tax credit. So it is a revenue neutral as far as entity as a whole is concerned. But however, on an individual basis, there would be a cash outflow will be there as far as branch is concerned. So kindly take into consideration. So any deemed supply, which is already a part of turnover in the audited annual financial statement, is not required to be included here. So basically, these kind of transactions we don't come across. All these things, is not recorded. So therefore, will have to be made a part of reconciliation statement. Now, transaction relating to stock transfer of goods, as I mentioned, it can be extracted from the delivery challan or on the analysis of e-way bill, whereas transaction of service transfer will be based on understanding of the nature of business. So I would like to give a couple of instances. Continuing with the same example, when a HO is rendering accounting services to the branch office or manpower services or HR services, or it may be IT infrastructure or other support services. Under these circumstances, where the transaction of the entity are not taxable, that means to say that if those transactions are exempted, now to give a simple example in case of hospitals, so any services rendered by an hospital to the patients are exempted. So under those circumstances, whatever the ITC is there, it will be subjected to valuation. So we have to refer to section 15 and respective rules where the valuation has to be carried out and the transactions will be recorded based on the valuations. So you have, though from the accounting perspective or income tax perspective, these transactions are not recorded, but from the GST perspective, it becomes relevant. Now take another scenarios. You have to take into consideration the nature of business carried out by the branch office. In majority of the cases, what will happen is the branches will have the employees, they have got the infrastructure, but however, invoices are not raised from the branches. All the invoices will be raised by the HO itself. Continuing with the same example, HO is in Karnataka, branch office is in Tamil Nadu. They have got an employees for the purpose of software development. They have got a office place, they have got a registration, they are incurring expenditure in Tamil Nadu, but however, there are no outward supply as far as Tamil Nadu is concerned. So these are the instances wherein you need to inquire why outward supply is not being carried out by the entity at a branch level. So this will enable you to questions, is there a cross charge which has to be adopted here, or is there a possibility of ISD, that is input service distributors? It is only with regard to services where HO receives the services and these services are consumed by the branch level or the manufacturing unit. So the ITC has to be transferred. So for that purposes, the HO needs to have a separate registration, that is ISD registration, and they have to raise ISD invoices. And the branch has to claim the ITC based on the ISD transaction. So we have to take into consideration, is cross charge applicable, or are there any ISD transactions which has to be given effect? Are they complying with the ISD provisions, that is input service distributor provisions, or a cross charge provisions? And this becomes more relevant where the entity is into both taxable as well as exempted services. Even if it is a part of the transaction is exempted, it is very, very important for us to take into consideration the valuations. Otherwise, at least the risk is minimum because it is a revenue neutral, and we can even take the benefit of this circular which states that in case if the entity is able to take the full input tax credit, whatever the value adopted by the HO to the branch or vice versa can be taken as the base for the purpose of GST. And even in case if no invoices is been raised, it will be treated as a zero. At least there is a cover as far as taxable transactions are concerned. But when it comes to the exempted turnover or a part of the exempted turnover, we have to be very careful because this will vitiate the disclosure what has already been done. So there would be an additional liability on account of reversal of ITC or blocked credit. Now, basically, when we refer to the transaction between the entities, that is between distinct entities, always we come across improper or incorrect valuation of the supplies made without consideration. So we have to take into consideration the valuation provisions. Another aspect is that they don't recognize the deemed supply of services between distinct persons. Now the department invariably, when they take up the case for audit, they will ensure that these transactions are being subjected to tax. They call for all the informations. So therefore, we have to be careful as far as these deemed supply of services are concerned. Sometimes it may so happen that the management is sitting only in Karnataka, and however, they are overseeing the functions of the branches. So the department may allocate the cost of management, which is very, very huge. And in those cases, in case if cross charge is not done, then it will lead to a catastrophe at a later point in time, along with tax liability, interest, and penalty. So we have to be very mindful as far as these distinct entities are concerned. Have a thorough checklist, discuss with the appropriate person, ensure that if there are any cross charge, means cross services, these has to be taken into consideration. As I mentioned, most of the cases, the branches doesn't record any outward supply because they are still following the old age regime, what was existing under the service tax regime, that is under the centralized registration. There is no concept called centralized registration under the GST law. So therefore, each transaction has to be evaluated independently, irrespective of the related parties. They may be belonging to the same party, but however, in the eyes of the GST law, they are two distinct entities, and it becomes much more critical in case if the transactions are pertaining to exempted turnover. Many a times it may so happen that in case of works contract or in case of other entities, they move the capital goods from one entity to another entity based on the delivery challan. And the goods are permanently stationed in the other location. These are all subjected to GST. So kindly ensure that in case if it is being transferred, even for temporary purposes also, it will invite the taxes until and unless it is for some other reasons other than for supply. For example, testing or for exhibitions. In those cases, there may not be any liability. But however, in all other circumstances, it will be subjected to tax. So they have to take into consideration these aspects into consideration. Now moving on to table 5, that is pertaining to credit notes which are issued after 31st of March for any supply accounted in the current financial year. But such credit notes were reflected in the annual return in form GSTR 9. See, what we are trying to look into these tables is that the difference between financial turnover and GST turnover and reconciling those things. It is similar to the bank reconciliation statement, what we normally use to prepare. However, these transactions are very rare in nature. Normally, these kind of situations will not be there. Now moving on to the next line items. In case where a financial credit note is issued by a supplier, it would not adjust turnover of the, it would adjust the turnover of the original supply, but recorded in the books of account. But however, such credit note would not be declared in the return under the GST. So what does it mean? Now take a scenario that the goods or services has been supplied, but however, at a later point in time, it is found that there is a defect and the period of specified or the specified period has elapsed. Under those circumstances, you can't, raise a credit note. So you have to raise a financial credit note in order to square off the transaction or make an adjustment in the payable receivable transaction. So these transactions, though it will have an implications from the financial statement point of view, but from the GST, no benefit of reduction in outward supply or taxes has been claimed. So therefore, this has to be disclosed separately. So the another item is discount offered post supply. As far as GST is concerned, whatever the discount you are providing, it has to be disclosed on the face of the invoices. Then you are eligible to claim the benefit of reduction in value of supply. There is also another scenario where there is an agreement between the buyer and the seller that based on the achievement of the turnover, there is a specific percentage of discount which will be offered for a specified period. If there is any such agreement well in advance and post the reaching of such an event, if discount is being allowed, So that will be taken into consideration and benefit will be given. But if no such agreement is existing, then in that case, any discount offered post supply will not be eligible to claim reduction in the output tax liability. So we have to take into consideration the agreement if there is anything of such kind is existing. The reason being is that all these benefit can be claimed only when there are specific provisions incorporated in the agreement. If there are no specific provisions in the agreement, then you cannot take the benefit of it. Similarly, you have to take into consideration the communications between both the parties. This we will come across where there is a wholesaler or there is a supply with regard to mobiles, where there are special discounts which have been offered based on the turnover achieved or the quantity lifted during a specified period. So those schemes has to be looked into and respective treatment has to be given effect to. Now table 5K is with regard to SEZ unit. Normally when SEZ unit supply goods to a DTA unit, the bill of entry will be filed by the DTA unit. So this transaction would not be considered for the purpose of GST as far as SEZ is concerned. So therefore, this amount has to be disclosed separately so that we will be able to arrive at the differences. As far as DTA is concerned, this transaction would be treated as import of goods. Now coming to 5L, there may be cases where registered persons might have opted to composition scheme. Many times what happens, composition dealer may switch to normal or regular taxpayer. Under these circumstances, the turnover has to be separately disclosed. And in case if they are subjected to GSTR 99C, so both annual return for regular dealer as well as composition dealer has to be filed. So this has to be taken into consideration and that turnover will be disclosed in 5L. There may be cases where taxable value and invoice value differ. It is because of the valuation principle. Now, as I mentioned that the entities might be supplying the goods at a nominal value, because in case if they subject the transaction at the full value, it will lead to GST output liability. So therefore, sometimes they resort to nominal value. And under these circumstances, if the transaction is between related party, it will be subjected to valuation. Therefore, the turnover as per financials and turnover as per GST would differ. So any such transaction needs to be reported under this table. Now, exchange rate differences is a normal phenomenon when there is a transaction between overseas entities. So either there may be a parent entity and Indian entity may be supplying goods or services. Because of the exchange fluctuation, the amount will be accounted in the books of accounts. So either it may be a gain or it may be a loss. So any such amount received forms part of the profit and loss account and it is not a part of GST return. So it is because of the purely accounting concept and does not form part of the GST return. Hence, there is no requirement of revision is required as far as GST returns are concerned with respect to exchange fluctuation. Very often we come across that an entity carries out the transactions on behalf of their customer and normally term it as a reimbursement of expenses or out-of-pocket expenses. They also even contend that there is no value additions on the transaction, but however, in order to act as a pure agency, there are specific conditions which needs to be fulfilled. And only when those conditions are fulfilled, this transaction will be outside the GST net. Otherwise, this transaction will be subjected to GST. So what are those conditions? There should be an agreement. Along with the invoices, the recovery of the out-of-pocket expenses also should be made a part of that invoices. The invoices should be in the name of the respective party. The supplier is only a means by which the payment is made to the service recipient on behalf of the customer, and the goods or services should also be received by the customer and not by the supplier of goods or services. Only when these conditions are fulfilled, then in that cases, it will be treated as pure agent and the transactions can be kept outside the GST net. Many times it may so happen that just because there is no profit element and the cost is recovered, they try to keep outside the GST net without fulfilling the conditions of pure agency as per Rule 30. So ensure that the conditions, what has been envisaged in the rules are being fulfilled. Only after that, the benefit of GST can be availed. Otherwise, there is an exposure. Now, all these items will be disclosed under Table 5.0. Sale of capital goods. In financial statement, we only record the profit or loss on sale of capital goods. But however, as far as GST, the transaction, full value of the transaction, that is the sale consideration, will be recorded. So therefore, because of which there will be a differences. So kindly ensure you need to review the audited financial statement. Before you carry out the GSTR 9 and 9C, kindly review the financial statement because it will throw most of the informations when you review the audited financial statement. Point number one is you should not only stress upon the profit and loss account, but also the balance sheet item, notes to account, cash flow statement, because many of the informations are available in these schedules, notes, which can be used for the purpose of correct filing of GSTR 99C. To give a couple of instances is sale of capital goods, it will be a part of cash flow statement. Sale of mutual funds, transactions in foreign currency, either it may be a export or it may be a transactions with related party, that is directors, or it may be transactions with parent entities, transaction in foreign expenditures. Ultimately, this has to be taken into consideration for reconciliation of our RCM liability. Take into consideration the financial means audited financial statement such as advances, balance sheet advances received from customer, particularly with regard to services, whether the transaction is subjected to GST or not, have reconciliations on that. Then verify the payments to vendors outstanding more than 180 days time. There is a liability because ITC which has been availed has to be reversed along with interest. And once when the payment is being made to the vendors, there is no time limit for availing the ITC. So all these information will be, taken into consideration even without going into the workings. So kindly make note of all these items. Another important aspect is with regard to, debtors, particularly with regard to exports, where the outstanding amount is more than 1 year. Kindly raise a red flag. And in case if the realization is beyond 1 year, point number one, you have to intimate the management that there is a liability, inherent liability on the transaction for non-recovery of foreign currency. What has been treated as a zero-rated supply will be subjected to GST at the rate of 18% along with interest, and interest will be a cost. In case if the amount is received subsequently, within 3 months, you can file a refund application and claim the refund of the taxes what has been paid. But however, it will have a implications on the cash flow because most of them, depend on the foreign parent entity wherever there is a transfer pricing agreement. They don't have any revenue apart from depending on the parent entity. And interest will be at the rate of 18%, which is also a very huge. Further, all the transactions where there is a non-compliance, you cannot take the benefit of LUT. The transaction will be subjected to GST at the rate of 18%. So this has to be communicated to the management very clearly in the first instance itself. Now take another scenario, input and capital goods sent to job worker, but is not returned within the prescribed period of 1 year or 3 years as the case may be. In those cases, though from the audited financial statement point of view, it is not a turnover, from the GST, there is a specific time period. And if the input and capital goods is not received by the principal from the job worker place, it will be treated as supply on the date on which the initial input or capital goods has been sent to the job worker. And interest needs to be computed from the date of the goods sent to the job worker. Now, goods sent on approval basis. Many times it may so happen that the daily items such as curds or batter, which is produced on a daily basis, these goods are sent to many of the shops on an approval basis. That means to say that only when they sell it, they will be the vendor will be able to raise the invoices. So there are certain cases, if it is not a perishable goods, where the shelf life is more than 6 months, it might be lying with the service recipient or the customer or the wholesaler. We have to ensure that either the goods are received back within 6 months or else the invoices has to be raised. And in case if it is beyond 6 months, invoices will be raised on the date when the goods have been sent on approval basis. So there is an interest implications which has also needs to be taken into consideration. The result of all such adjustment in the revenue is annual turnover after adjustment. So which would be an auto-populated. Now, the moment when we get these turnover, it has to be compared with the turnover as per GSTR 9. So table number N figure has to be taken in table 5Q. And the resultant figure might be a positive or a negative. In case if there is any differences, now we need to provide the reasons. I would like to stress upon the erstwhile regime, how difficult it was for the assessing officer, to carry out an audit. Whenever they find there was a VAT 240 audit report where there, though the differences was there, but on what account they were not able to understand it. So because of the lacuna or the flaws in the previous regime, GST law has come out with the differences, whatever the differences, it may be on account of outward turnover or it may be on account of ITC. The reasoning has to be provided in the reconciliation statement itself so that the officer will be able to consider without the representation by the assessee. So kindly ensure, in case if there are any differences, it is appropriately worded so that the other person is able to understand. Now, on what account there would be a difference in this? So transaction reported in delivery challan, that is during a financial year for supply on sale on approval basis beyond a period of 6 months, shall be deemed to be supply under GST. However, there will not be any revenue recognized in the books of account. So these are the reasoning which has to be provided in the reasons. And you can add the number of reasons in the reconciliation statement. In the previous table, what we have done is we have compared the turnover of audited financial statement with the GSTR 9 turnover, that is on a gross basis. Now that turnover also includes exempted, nil rated, non-GST turnover or no supply turnover, or zero rated supply without payment of tax, or supply on which tax is to be paid by the recipient on RCM. So these are the transactions which has to be removed in order to arrive at the taxable turnover. Why we need to arrive at the taxable turnover? The reason being is that we need to compute the tax liability based on the reconciliation statement. So therefore, we start with annual turnover after adjustment, which is from the previous table, which is auto-populated. Now, we have to deduct the value of exempted, nil-rated, non-taxable supply and non-supply turnover from the annual turnover after adjustment to arrive at the taxable turnover. So essentially, 7B comprises of four supplies. One is supplies taxable at nil rate of tax, supplies that are wholly or partially exempted from tax, non-taxable supplies such as alcoholic liquor for human consumption, petroleum product, or no supply as per Schedule 3. All these transactions has to be reported in table 7B. Now, as far as 7C is concerned, it is zero rated supply without payment of tax. Either it may be export or SEZ. Those transactions has to be reported in table 7C. 7D is very, very important. Now, where the supplier is supplying goods or services, the tax on which is liable to be paid by the recipient, then such supply would be treated as exempted. Most of the time, it may so happen that GTA services, when they are charging 5% without ITC, where the tax is paid by the companies who are registered. So those transactions will be covered under this. Now, what is the implication of 7D? The moment when any transaction is reported here, that means to say that it is an exempt supply. The moment when it is an exempt supply, you need to take into consideration the reversal of ITC as per Rule 42-43. So whenever you come across the in this, verify whether sale is also been made or not. So the data entered under 7D is supplies made by the supplier on which tax is to be paid by the recipient. One of the example is advocate. When they disclose in 7D, it is the company who pays the tax on the advocate services. So for the advocate, it is an exempted supply. For the company, it is an RCM liability. Similarly, there is a GTA, is neither charging GST nor availing ITC, and GST is payable by the recipient under reverse charge. That is when GTA services is rendered to the company. Then the said turnover would come under this entry. Another scenario is services provided in the capacity of a director to a body corporate. So under these circumstances, in the returns of the director, it is reported under 7D, and the company will pay tax on the RCM basis. So once when you find an entry under table 7D, kindly ensure that rule 4243 has been computed. Many times it may so happen that rule 4243 has to be computed not only on the monthly basis but also on the yearly basis. But yearly basis it is missed out. Kindly ensure that you take note of computations on an overall yearly basis also and find out any excess or short is there. So table 7F will be a taxable turnover. So this has to be compared with the turnover as reported in GSTR 9. So there it is 4N minus 4G plus 10 plus minus 11. You take into consideration the transaction that has happened post the financial year, that is transactions which are reported up to the specified period. Now, any differences, we need to give the reasons for the differences. So as I mentioned, these transactions with regard to sale on approval basis is one of the example. So on this account, there might be a differences in this turnover. Now, we have first compared the total turnover with the total turnover of GSTR 9. Then we arrived at the taxable turnover compared with GSTR 9. Once the taxable turnover is arrived at, now we need to do the reconciliation of the liability. And this has to be done on a rate wise. It is always important for us, to have appropriate outward register with all the fields. Take into consideration the rate of taxes, also intrastate, have a validation check, reverse charge liabilities, and also take into consideration the HSN. Most of the time, may so happen that the entities will not do a thorough check about the HSN, what they are capturing. The HSN and SAC code and the rate what they are capturing are two different things. So on a test check basis, it has to be reviewed. In case of services, not many items will be there, but in case of goods, a lot of effort is undergone, in verification of rate, because sometimes rate may change. To give a couple of examples, cattle freight is subjected to tax. The classification has to be taken into consideration. Also, the notification has to be given effect to. And are there any lab tests? Because sometimes they may treat it as a residue and subject it to tax. However, the cattle field per se, if it is classified under that category, can be claimed as an exemption, but it all depends upon the category of goods. Further, in case if any brand is being used, it will be subjected to tax. So all those things has to be considered. Not only that, you need to take into consideration the interest, late fee, penalty. Normally, this penalty may not be there until and unless if there is a visit inspections wherein they levy the penalty. Otherwise, there may not be any penalty. And this has to be compared with annual return, taxes paid under the annual return. And if any differences are there, we have to give the reasons for differences. So here we are comparing the taxes as is computed based on the 9C on the taxable turnover with the taxes paid under GSTR 9. So here we need to take into consideration, as far as GSTR 9 is concerned, if any differential tax is being paid as per table 10 and 11, even that also needs to be considered. So as I mentioned, we need to give the reasons for differences. Now, when we do the comparison, there might be an additional payout which has not been paid in GSTR 9. So this additional liability has to be captured rate-wise. This will enable you to compute the correct outstanding liability. Also, you need to take into consideration the interest in case if there are any delay in filing the returns. Of course, now you are not even eligible to file the subsequent returns without filing the previous return. So therefore, this may not be a relevant thing. But however, if there are any delay, in those cases, interest also needs to be taken into consideration, and this liability has to be discharged. So the registered person is required to pay the additional tax liability. Further, there are chances that the taxes might have been paid in excess. Under these circumstances, appropriate disclosure will enable the assessee to make a claim and file the refund application before the authorities, excess paid under other categories. So therefore, GSTR 9 plays a very prominent importance for the reason that if any excess payment has been paid and if it has been captured in GSTR 9C, it will also become a documentary evidences to file the refund claim, which can be substantiated with GSTR 9C because it is a reconciliation statement. If it is missed out, then it becomes very difficult to make a claim because the GSTR 9C may not have a relevant observations with regard to excess payment of taxes. Then in that case, the department may not sanction the refund. Up to the previous table, we have computed we have made the comparison between the financial statement turnover with GSTR 9 on a gross level. Further, we have done the comparison of taxable turnover and taxes paid as per financials, as per GSTR 9C and the financial this thing 9. Now we move on to the reconciliation of net input tax credit. So when it comes to the input tax credit, it is a normal phenomena that the ITC might be booked in the earlier financial year, but it has been claimed in the current financial year in the annual returns, GST returns, or it may be booked in the current year, but it will be claimed in the subsequent financial year. So These are the reasons because of which there will be a differences in ITC. So once when you do this comparison, you have to compare with the annual return. Kindly also ensure that you do this comparison with electronic credit ledger. The reason being is that ultimately whatever is reflecting in the electronic credit ledger should be reflected in the audited financial statement. Many a times there is no mechanism of reconciliations year to date, because of which there are differences. And these differences, the moment when you don't reconcile at any particular point in time, so over a period of time, there would be a very huge reconciliation, and because of which there might be a probability of raising demand by the department. Kindly ensure your electronic credit ledger balance is mapped with books of accounts and any reconciliation is adjusted appropriately. Similarly, electronic cash ledger also is been reconciled. Entities have to internally derive their ITC for each individual GSTN and declare the same year. It is not on a consolidated basis, it is based on the GSTN wise. This information has to be reported. Here we normally face challenges in case the books of account is not maintained on a branch level wise. Many a times the accounting team segregate the ITC based on the vendor, taking into consideration the invoices, physical copy or the address captured on the invoices. Therefore, it is always important to ensure that appropriate working is being maintained by the assessee, and you take those working before you start compiling the information for GSTR 99C. When we were referring to the audited financial statement, as you are aware that audited financial statement is based on the PAN basis. Now, what are we referring to under these circumstances? Because we don't get that figure from the audited financial statement. So under that circumstances, it means or it implies to the books of accounts. We are comparing with the books of account in case where the entity is having multiple GSTN. Now the net ITC available for utilization should be compared as declared in table 7J of the annual return. Now 12F of Form 9C provides for the difference between ITC as computed from books of account and ITC as claimed for the financial year in the annual return. It is not always that the shortage on account of outward supply, there is a tax liability. There can also be a tax liability because of differences in ITC between the books of account and annual return. In case if there is any excess claimed in GSTR return, that needs to be reversed or it has to be paid in case if there is no ITC available. So the demand or the tax liability can be on account of outward supply, shortage in outward supply, or it may be on account of excess claim of ITC or ineligible ITC claimed in the returns. Now coming to the differences. So these differences, as I mentioned, in case if the difference is positive, that might be because of ineligible ITC not availed in the returns, or ITC which has lapsed has not been availed. Now in case if there is a negative, it is a duplicate ITC, means we have claimed more ITC when compared to books of accounts, or ITC of the subsequent year when goods or services were received later, but their invoice was received prior was availed. Just to give an example, now on 28th of March, I have received an invoice And this invoice has been raised by one of the vendor who is in the state of Delhi, and the goods is moving from Delhi to Karnataka. It is in transit. Based on the invoices, I would have taken the ITC in my GSTR 3B. But actually, I am supposed to take the ITC in the return only on the receipt of goods. One of the conditions for availing ITC is I have to receive the goods or receive the services only on the receipt of goods or services along with invoices. I am eligible to claim the ITC. So we have to take into consideration these aspects and then give appropriate treatment. Though this is optional, but however, it will throw a lot of informations to the GST authorities, particularly when they take into consideration, say, for example, column number E. If any expenditure is there on account of insurance, for example, employee insurance, ITC is blocked, or insurance on vehicle, ITC is blocked, or goods lost, stolen, destroyed, written off, disposed of as a gift or free sample, ITC is restricted. Or it may be with regard to entertainment charges, where it includes staff welfare or expenditure incurred on account of annual gathering, where it is not in furtherance to the business. So the department will be able to identify the expenditure on which ITC is restricted or blocked, and then compute whatever is the eligible ITC. Hence, this becomes very important. Now coming to column number M, repairs and maintenance. It must happen that the entity might have incurred expenditure on account of vehicles, which is restricted, or some of the items might be mentioned under miscellaneous items. So the list, what has been given here is only an indicative list. The assessee is having an option to add on the expenditures, relevant expenditure here. Even column number O, on account of capital goods, for example, you may have incurred expenditure for the purpose of addition to the factory building, or without the civil works for the installation of the machinery. Only in case of civil work for the installation of the machinery is allowed as an input tax credit. All other expenditure on civil work is restricted. So once when the authorities verify the expenditure, they will come to know the eligibility or ineligibility of the ITC or a block credit. And accordingly, they want to verify the books of accounts and returns and ensure that no ineligible ITC is claimed. Ultimately, whatever is the eligible ITC is there, that eligible ITC will be compared with ITC claimed in annual return. And any differences, it has to be explained in the next table. So this table is for reconciliation of ITC declared in the annual return against expenses booked in the audited financial statement or a books of account. So various subheads specified under this table are general expenditure in the audited financial statement or books of account on which ITC may or may not be available. So there may be an expenditure there, but ITC is not claimed, then you need not disclose in that particular item. Only when ITC is claimed, then disclosure is relevant. So further, this is only an indicative list, as I mentioned. You can add the add or delete any of these items. And table 7J of the annual return is taken into consideration for filing this table. Now, this point requires detailed examination of books of account to establish that registered person has taken only eligible ITC. Now, when you categorize the expenditure, we'll come to know whether ITC is eligible or not. So this will facilitate the auditors or the consultant who is carrying out the GSTR 9C for the purpose of eligibility or ineligibility of the ITC. So even though it is optional, kindly ensure that in case if the informations can be collected, kindly provide the same. The reason for differences is the beauty of this reconciliation statement. Even though the person is not involved with the GSTR 9C, he will be able to identify on what account these differences are there. Only condition is that it should be appropriately worded so that it will give the essence of these differences. Sometimes the reasons are very vague. It is always better to give a detailed reasoning for differences in reconciliation and appropriate actions also. Now, difference can arise on account of any of the following reasons. One is ineligible ITC availed by the registered person. Now we move on to the next table, that is table 16. Tax payable on unreconciled difference in ITC. As I mentioned that it is not only on account of outward liability, but also on account of ITC also there will be a liability which will be arising. Now that needs to be paid in this table. So amount payable due to reasons specified in table 13 and 15 above shall be declared here. And table also demands computation of interest. So penalty, normally there will not be any penalty until and unless there is any inspection. Because if you are making a voluntary payment and it is being informed to the authority, there will not be any penalty. And penalty, there should be a show cause notice. Only after that they can invoke the penalty. Now, any additional liability due to non-reconciliation, first it has to be computed rate-wise. This table also includes both outward as well as liability on account of input tax credit, interest, and other items. So there might be a situation, for example, in case if the assessee has received the refund on account of export of goods. Now, one of the conditions for export of goods is that the goods should be taken out of India. Point number one. Point number two is that they have to receive the foreign realization within 3 months. In case if the amount is not received, then the department may recover that amount. And if the consultant identifies these things, so it is a kind of an erroneous refund which has to be paid back. Now, outstanding demands to be settled. So all those items will be covered in this table. So table 5 consists of additional liability to be discharged by the taxpayer due to non-reconciliation of the turnover or non-reconciliation of the input tax credit. So any refund which has been erroneously taken and shall be paid back to the government shall also be declared in this table. So this is very important. Now, in case if there is any liability, the taxpayer has an option to pay this additional liability by way of DRC03. Taxpayer can select reconciliation statement in the drop-down menu while filing DRC03. And the liability has to be paid only through electronic cash ledger. If any liability is there, it has to be paid through electronic cash ledger, barring few cases where it can be utilized by way of input tax credit. So with this, we conclude the GSTR 9C. Hi, John.
Hello, sir.
Yep, Harshita.
Thank you so much, sir.
Thank you.
Sir, I extend my heartfelt gratitude to each one of you for being a part of our GST webinar. It was so good that we learned so many things about GSTR 9 and 9C, how to file, what are the tables it requires, how to reconcile everything. You taught us so well, sir, to fill and to do GST returns. A special thanks to you, sir. You are the one person who made it so good, so good. Also, I want to express appreciation to our participants. Event like this thrive on enthusiasm and curiosity of the audience, and your presence has made the significant impact. Thank you once again, everyone. Have a great day.
Thank you all for your patient listening. Thank you, Harshita.
Thank you, sir.
Thank you.